Hi, everyone. We're just waiting a couple minutes here to get started. Well, one more minute. It's just 1 minute to 1, and then we'll kick things off. Let us know if you can't hear us right now. We'll use this as an opportunity to sound check. So if you're having difficulty hearing us, please let us know.
We like to turn the sound off at the start so that people can't hear our dumb jokes.
Can't hear us saying the slide's not right. Okay, so we got a few people saying they can hear us and one person saying they can't. William, it looks like maybe you can't, but everyone else can. So maybe kind of play around with something on your end. Awesome. Thanks, Gan.
It wasn't a joke. It was me clearing my throat.
And we kick off the song. Let me clear my throat.
I like that's a good song.
Okay, great. Looks like William can hear us now. Perfect. Let's get started. It's 1 o'clock right on the dot. We can have other people join us as we get going, but let's kick this off. So welcome to the Cash Flow Careers webinar series, Pricing, Packaging, and Selling of Cash Flow.
Woo!
And of course, that's us. Let's start with the agenda for today and begin with a bit of housekeeping. So we have allotted some time at the end for Q&A. So please use the Q&A box at the bottom on your Zoom menu bar to ask us a question. We will try to make sure that we've allotted enough time at the end to be able to go through those questions for all of you. Then we will speak about our background, and then we'll dive right into the pricing, the packaging, and the selling. All right, so why don't you kick it off? Who are we?
We've done this so many times, I don't even know.
I know.
It should be like templated.
I know, there's probably a number of you who already know who we are, so we will keep this brief.
Yeah, Twyla and myself, we have our own cloud accounting firm here in Calgary. Started in 2014. It's nice that we actually have the year down here so I can remember how many years we've been in business. It's actually been around 5.5 years. We really focus on part-time controller, part-time CFO work, but we do handle everything from bookkeeping all the way to very simple tax returns. We love to play in the advisory space, even though we don't like using that word, the dirty word. We kind of see ourselves as business consultants, financial partners. So hence why we're doing what we do now. We've created our own cash flow app. Really love the space and love helping people and just kind of teaching from our experiences. We're probably terrible teachers, but we have lots of experience.
Well, and we've become a bit obsessed with sharing our information and sharing our experience more than anything.
Yeah.
To give that back to the accounting and bookkeeping community so that you in turn can pick what you want from our experience, take the things that have worked for us, and maybe some of that's going to work for you, and you can roll that out as a service for your clients. So we have become pretty involved in trying to give back, whether that's to users of Helm or to opportunities like this where we get to host some webinars or even jumping on some other app webinars, really just giving back about our experience. Because as Kelvin said, we've lived in that advisory space before advisory was a buzzword. It's where we've always kind of sat in terms of the service offering that we've given to our clients.
Yep.
All right, let's jump on in.
So this is going to be a big one.
This is going to be a big one. I have to have notes today. That's how big it is. And so let's begin with pricing. And I think this is kind of a good place to start. And really we're speaking from, again, our experience, but also questions that we get asked in terms of how do you price cash flow? So let's kick this off with kind of the basic conversation that I think is good timing to wrap this in here is value pricing versus hourly pricing.
And go.
I'll let you. I feel like I could hug the mic, so I don't want to.
Well, you can.
I don't want to be that.
No, for us in terms of pricing cash flow, it's a very interesting space because the dichotomy between value pricing and any other approach is super apparent in this space. And so it's easy for me to speak in examples and I'm not allowed to because my example comes on the next slide. But the main point here is that for pricing cash flow, short-term cash flow services, really focus on the value for this pricing. And I know it's easier said than done, and we'll kind of get into that as we go along here. But this is probably a really key point in the entire bookkeeping and accounting process where value pricing really does matter because there's such a difference between that and what your hourly billing is. So if I feel like I can charge a service out or do the work in 2 hours and charge $200 per hour, my billing is $400, but the value to my end client might actually be, say, $1,500. And so there's huge ranges and variability here to play with. And it's just something to be really, really cognizant of, because it doesn't happen in a lot of other spaces. Like commoditize, say, data entry is a good example. It's really hard to have a huge variance in the pricing. That exists here. So it's something to be really, really aware of.
I think, when it comes to pricing your cash flow services, there is the opportunity to price it on value pricing or to price it on your hourly billing. And one thing that we can share is that when you first step into the realm of offering cash flow as a service, it is time consuming. You are learning how to do it. You're figuring out the best process. You're figuring out the best tools to use. In some cases, you're trying to get more information from the client than you've ever have in the past. And truth be told, your client may not pay you for all of that time. And so, to have hourly billing right up front, kind of be warned that they might not pay for that time up front. And on the flip side, you're going to gain efficiencies. Once you get into a rhythm and a routine and you figure out the tools that you're going to use, then cash flow, it goes to the other extreme of it doesn't take you hardly any time at all. Yeah. And so should your client only be paying you for the 15 minutes each week that it takes? And so, for us, we've talked a lot about pricing it and what that looks like to be value pricing and hourly pricing or hourly billing pricing is that you have to be mindful of what is your client's tolerance? Mm-hmm. What are they going to be willing to pay up front? And then on the flip side, what are they still willing to pay in the future when now you've got the cash flow into a rhythm and a routine and you're doing it really efficiently?
Yep. And I think that's a great point. I mean, learning curve is huge. And so up front, you'll have a huge one. And on the back end, it's not even just in your processes and how you work in your own workflow. It's probably even in the relationship. So the more you get to know your client, it's going to take a lot of work up front. But the more you get to know them, the longer that relationship exists, the more you just simply know about your client and their actual company position. You'll have a much better foundational layer of understanding about the business and what you need to do, and that'll make your work infinitely easier over time. So there's big learning curves across the board. And as we were discussing even this morning, it doesn't apply to just solopreneur type shop. It also applies to firms, probably even more so, where if you're shifting the work to employees down the chain, you really have to be aware of the learning curve and the inefficiencies up front, and try not to price based off that. Because in the long run, you'll lose all day long trying to do that.
Yeah, I think biggest thing that we want to kind of mention here is that what is it worth to your client versus how much time is it taking you, or what's the cost that it is that you're absorbing in order to deliver that service? Because the client, the client's tolerance or the client's value that they're going to place onto cash flow as a service may or may not be directly reflective of how much time you're spending on that, or how much time your team members are spending on it, depending on where you're at in the process of delivering cash flow, firstly in your firm or your bookkeeping practice or your accounting practice, and then secondly for that particular client. Yep. So, I think this is also a great time I always just love the quote where they say that, you're not paying me for the, how does that go? The 15 minutes that it takes me now to do this service. You're paying me for the 15 years or the experience or the expertise that brought me to the point that I can now deliver that in 15 minutes. So I love using that for not just cash flow, but for any sort of advisory services that are value-based.
And I think a good thing to point out there is it's not just the 15 years of experience that's needed. Quite often you can skill yourself up very quickly and still have the expertise.
Yep, for sure. This is so sensitive. I'm gonna stop using my mouse. Okay. All right. Now, here's where you can actually dig in. So you've been dying to share. So let's start with talking about our own pricing experience.
Yeah. And so for me, I love to speak in examples. And so the difference between value pricing and hourly billing and cost, we have a really good example within our own firm. We had a energy services client. We deal with them quite a bit here. It's Calgary, Alberta. It's the energy capital of Canada. went through a recession. These guys got into a really tight spot. They actually had $1 million working capital deficiency. So basically they were bankrupt, and, you know, the downturn happened. Banks started talking to them quite a bit. They were on the cusp of insolvency. So that kind of lays the framework that these guys were in a really bad spot. You know, they needed cash flow forecasting and cash management. That was their primary service and need right there and then. So the value to them was extremely large, whereas the actual effort and workload for us as a firm, because they were existing clients, was actually quite low. You know, even using manual methods at that point in time, we were using Excel as our forecasting tool. That would probably take me anywhere from an hour or two per week. So again, saying if my time's $200 per hour, let's call it an hour per week, that would be $800 per month for that particular service. These guys, again, you know, we're talking bigger dollars than that. So they're $1 million working capital deficiency. They needed to get out of the hole, or else they're just simply done. $800 was just simply way, way, way too cheap. And so our end pricing was probably somewhere around $1,500 or $2,000 for that particular client. And ultimately, over 2 to 3 years, we actually turned them from $1 million working capital deficiency to $1 million working capital surplus. Obviously, we didn't do all of that work. We just helped manage their operations, and they did amazingly well through a very hard time. But the main point there being is that they saw massive value in the service that we provided, because we helped them through an extremely difficult and stressful time. So the value was super high. In fact, $1,500 to $2,000 was probably not even enough at that point, especially when they were cash flow positive. And once we started using different tools like Helm, shameless plug, which we don't like to do, but I'm simply saying that my hour forecasting went down from an hour to probably 5 to 10 minutes per week. And, you know, as we build the tool out, it's going to become even more efficient and faster over time. And so because I'm getting faster, should I be charging less to my client when they're already thinking it's probably cheap enough? I think, or too cheap. I think it's a great example of the value pricing versus hourly rate versus even your cost, where their value's up here, our hourly rate's here, and our cost is probably even lower and going down. So again, it really highlights the value proposition. Don't underestimate it, because it's a huge divide in this space.
Yeah, for sure. And I mean, the tools that, this kind of jumps to our last point, and I want to still come back to these other points, but the tools that we use for any service that we're offering to the client obviously plays into the time that it takes. Ideally, you're using a tool because you're trying to solve a pain point, or you're trying to become more efficient. So it plays into the time that it takes, but it shouldn't play into the price that we charge. And it's easy to think, well, this is only taking me now 15 minutes. So I could actually charge them less. But you have to kind of, and we have this experience ourselves, you have to really stop yourself in your tracks and say, wait a second, but I'm still providing the same level of value to them, even though I've become more efficient because of tools, or even just because of time and intel with the client. So we have made that mistake before, where we think, oh, we should give them a discount now because we're doing this so quickly. And you know, we have kind of had to say to one another, don't be silly in this moment. Like we've got the opportunity here to keep our pricing the same, or to have the incremental increases that, you know, that you can kind of absorb in your firm, and that your clients can absorb. You don't have to retract and go back to a price that is not representative of the value that you're giving them anymore.
Yep. And I think it's another good point too, is that the more that you use the tools and the apps and everything that's out there to provide a better customer experience, in fact, your price should be going up, not down. Because again, you know, our model specifically is, you know, we'll talk about this later, but we're really trying to help our clients and really trying to give them peace of mind, and that, you know, the value starts going again much higher, not lower. And the more that you can make yourself efficient, it's just simply you're winning. You know, you're making more profit off that job.
Yeah, for sure. So, you know, the advice that we tend to give to people when they do say, how do we price for this, is to start somewhere, to pick a number. And that's really been our strategy when it comes to any fixed fee pricing for any of our clients, is we've had to start somewhere. And then we try to quickly get information on, is that the right price? And that can be based on, you know, what sort of effort we are putting into it. That can be based off the client tolerance. That could be based off of the market. Kelvin mentioned we're in the oil and gas We're in an oil and gas zone here, and so we're very subjected to tolerance in that respect. And so, start with that pricing point and use that as your comparison. Did that work or didn't it? And why did it work or why did it not work? And then iterate off of it. And we're constantly kind of figuring out like what is the pricing for a particular service or a particular whole suite of services for a client. And we often, once you start somewhere, then we'll often use that as our reference point. When we have a new client that we're pricing out services for, we go back to other clients to say, who's the closest to this and what are we charging them? Is that making sense? And use that kind of as a benchmark per se to price in the future. And I think it's a case of, there's no real science to this in our experience. It's really just become art, and we do a lot of gut checks. Does that feel right for that particular client, that industry, that stage in their life cycle of business, etc.?
Well, and I think also getting dialogue from the client too. It's not just all internal, us referencing our own stuff. It's also us talking to the client and actually asking them over time, does this feel right? You can feel it on the other end if you're overcharging or undercharging. Just through dialogue with the client, you're going to figure that out. And so if you've overcharged and aren't providing the service, you will hear about it. And if you've undercharged and are still providing that same level of service, you will feel it on your end in terms of pressure, additional questions. You'll just have that general sense. And so the more you dialogue with the client, the more that fleshes out too.
Yep, for sure. Great. I think that sums up pricing, unless there's anything else that you want to touch on there before we move on.
Nope.
All right. Perfect. So let's move on to packaging cash flow. Want me to kick this off? When we think about packaging cash flow, we're talking about incorporating it in the service offering that you're giving to your clients. And one of the first points that we want to make is the tools do matter. We've admitted that we've used Excel as our cash flow forecasting tool for 4.5 years of our existence as a firm. But those tools do matter, and that those tools did affect how we packaged it and who we even packaged and gave it to.
Yep.
So the tools do matter. The data quality definitely matters. And this is something that we've spoke about in the past in terms of clean data and even, what does clean data mean and what does timely data mean? And that certainly plays into how you package your cash flow services. And then the process matters. So how are you getting to the spot where you're able to have the clean data and then use the tools and give it to your clients? And so that all matters in how you package this for your clients. So let's speak right to what this looks like in terms of a client relationship. And, admittedly,
keep going.
I because we've done cash flow as a service for so long, I will admit that I kind of forgot what it does in terms of changing the client relationship. And I was reminded last week when I was on a call with one of our industry colleagues, and she's starting to embrace cash flow forecasting as a service for her clients, something very new for her. This is kind of a new territory. And as we talked through what this was going to look like for her delivery to the client, we stepped back and said, okay, how are we going to package this and fit it into the workflow? To which she said, wow, I'm actually really going to have to talk to my client a lot more than I do. Mm-hmm. When in the past, all I've been doing is, the bookkeeping and then the monthly work. When I say monthly work, I mean things like financial reports, GST returns, payroll. She's doing an abundance of tasks, but everything's kind of in the past or on a necessary basis. And necessary, I mean payroll. Versus now this is her first kind of forward projecting forecasting experience. And she really, really kind of caught me in my tracks to say, like, this does make a difference to what the client relationship looks like, what the dialogue looks like, and how that now affects how you package it and affects workflow.
And going back to your pricing, it affects your pricing as well.
Mm-hmm.
Because we were even talking this morning where it changes your relationship. And we're very used to it because our entire business model was based off part-time controller, part-time CFO. So we were always continually talking to our clients all the time. And so we always told people that our firm was very high touch, low volume in terms of client load. And that's kind of what we're talking about here in terms of the client relationship, is that there's more touch points. And so
Mhm.
you're not talking once per month, you're probably talking once per week, maybe once every couple of days, maybe even every day,
Mhm.
if the cash flow needs are really tight, if their cash flow is very tight, which then plays into the pricing because, you know, not that we're value or pricing based off time, but we're saying your relationship's going to be much stronger with the client. You're going to be serving them much more. And so that value to the client is going to be much more. You're going to be the true financial partner that they've kind of always wanted, and probably maybe not even wanted, but needed
Mhm.
in order to progress their business to that next level. And so those touch points play into the pricing as well.
Yeah, for sure. So let's share about our packaging experience. And for us, like I've already said, uh, cash flow forecasting has been a part of our package that we've offered to a lot of our clients since day one. And cash flow forecasting for us leads to cash management. And there's two reasons why that happens from our side. And that's one is that you have to be mindful of when you do a cash flow forecast, if you are not also helping out with the cash management, that your cash flow forecasting can be a little bit frustrating if you have a client who likes to pay vendors. And believe me, I've lived in this world, and it's extremely frustrating when you do your cash flow forecast and you think, okay, I've mapped this out, and if we follow this plan, we will still have enough money for payroll and rent. And then if you're not handling the cash management, your client may or may not have heard that message, and that they start to issue payments. And so we end up kind of taking over the whole cash flow forecasting and the cash management, which then puts us in the driver's seat to ensure that they're not messing with our forecast, and they're not kind of putting us in a spot where we have to do a complete 180 because now we don't have enough cash for payroll anymore. So we've got to remap out what we're going to do over the next few weeks, because if we kind of didn't change it up, that they wouldn't have enough money to actually follow through on some of those commitments. So it's something that we've always wrapped together, is the forecasting and the cash management, and that becomes, again, a big piece of the picture that the clients are looking for, that they don't have to deal with that side, and they can kind of pass the torch and let somebody else manage it. And you have to really watch that. There can be scope creep, and we've experienced that too. And one way to avoid the scope creep is to be in control of the cash management, because the scope creep can often look like them trying to trigger payments, or that they've made commitments to vendors that you're not aware of, and that they turn around and need some things changed, or need some payments made that you weren't planning for. And it can result in it being a more inefficient process than you would like it to be, and that you planned on it being.
Yeah. And I scope creep to me is a very big piece of the picture, because when you are packaging this as a cash management, cash flow forecasting service, it's really important that they follow the plan, as Twyla said, because if they don't, I mean, the processes can be super streamlined, matches all your expectations, you have the value pricing all laid out. But, we'll get into this later. It's quite often that people that look for these services are usually in a little bit of distress. And so they have a heightened sense of emotion around things, and they get very trigger happy. And in being trigger happy, they tend to do things that aren't per plan. And so essentially what happens is you continually have to rejig your plan all the time. And that's what causes really big scope creep, which just blows up the entire process and project.
Yeah. So it's definitely something to watch for, something that we can kind of give back as our experiences, to really be mindful that can happen. And it happens most often if you're not completely in control of the cash management. So let's talk a little bit about this, because I know, Kelvin, you talk to a lot of people who are kind of trying on Helm and seeing what that's like, and giving that a test drive. And then they quickly go to the question of, well, how do I fit this into my workflow?
Yeah.
So what we wanted to do today is to share with you, and we can send this out after as well. This is what our workflow looks like. And I think we've got the time to walk through this, and it might seem a little granular, but I think it's something that it does seem to come up often. And it might be helpful for you to understand at least what we're doing. And we've always said this, there's more than one ways to get to the end result. This is us simply sharing, here's what process we've used in our practice, and kind of really outlining that for you. And it shows really clearly where we fit the cash flow forecast into that.
And I think keep in mind here that, again, our firm 2080 is end-to-end. So we do bookkeeping as well as the business consulting. So a lot of this workflow will be largely based around a bookkeeping process, whereas the advisory is kind of an attachment to it per se. And, that's literally how you hook cash flow forecasting and cash management into it. Is it's, a piece at the end of the puzzle. Now, going back to what Twyla said, if you're not a bookkeeper or a tax accountant or somebody else, like, there's multiple workflows here. It's just figuring out what your process would look like. So if you're, more traditional accountant and you're not really doing the bookkeeping, it's probably a case of partnering with a bookkeeper and trying to figure out a workflow that would look similar to this structure.
Yeah, for sure.
And so,
why don't you go ahead and walk us through?
Sure.
Yeah.
I don't know. Can I point with the?
You just gotta be careful because it flips to the next.
So at the very high level, with our clients, we use a lot of automated data entry systems. So HubDoc, Receipt Bank, auto entry, all of those kinds of tools. Our first step is literally onboarding the client so that they truly understand and are trained and leverage these systems to the best of their ability and ours. The reason that we do that is because we sell our services as being peace of mind and kind of all-encompassing, and allowing people to kind of take a step back and focus on their service or their product or widget. So all they need to do in our process is take a picture or forward an email, essentially, is all that they need to do. We really leverage the technology so that they just have to do that, and the rest of the process literally is on us in terms of the bookkeeping workflow. So that would be the top level here, is going through the setup and training on the mobile apps that would be available, setting up any unique email addresses so you can forward PDFs into the systems. And if the systems have fetch, capabilities to pull bank statements, setting those up so that you have those as well as any bills that are available. Trying to make the data entry piece as efficient as possible. That's an ongoing responsibility. So this is the next tier. Once you've started them out, trained them, set them up, this is a continuing thing that they need to do. They need to continually take pictures for the PDFs and essentially maintain the bank account logins for the bank statements. Once it goes from there, the actual automation systems do what they need to do, which is they either recognize the documents and they push them through into the accounting systems, whether that's Xero, QBO, or Sage, or they don't. And if they don't, then it's up to us to look at why. We don't actually do the coding in these systems. We actually do the coding in the accounting system. What we're worried about is training the systems so that they don't fail again. We really try to avoid coding in the system. We've just seen it in the past where people then get in the habit of just coding in, say, HubDoc, and that just takes a lot of effort and time. And so again, we're trying to make the data entry and data collection as efficient as is possible. That then rolls into the accounting system. We then code it, make sure the GST is right, verify the dates, approve everything, do what we need to do. And I guess that would be all of those points that I just talked about. Do the bank recs, and essentially we make the data as clean and correct and accurate as it's possible, and up to date. Cash flow forecasting and cash management, you need to be real time. And I use that term loosely because that can be as current as probably 7 days to 14 days for somebody that's very, in need of a very current cash flow forecast, where other workflows you could actually probably have it a month out if you knew some of the other transactions involved. Going back to, you need to know a lot about your client here and their processes and workflows and what their ambitions are in terms of spending and revenue. So what we'll do is we'll go through and we'll make sure that the system's clean, the data's correct, and we'll actually produce accounts receivable, accounts payable reports, and we'll look at those just to get a high level of what's outstanding essentially, and what outstanding items are we missing in terms of backup or transactions. Then that is where we fit the cash flow piece. So again, we use Helm. That's not a sales pitch. That's just what we use. Used to be Excel, used to be Google Sheets. And that's where we would fit it in. So we would make sure the system is clean, the data is clean. We'd push that into our cash flow forecast. And then we would start, manipulating and seeing the recurring entries, where's our cash balances at, the look forward information. And so using that information, we could then have our weekly dialogue with the client. We have a lot of weekly workflows where we said, here's the cash flow forecast. I know all your outstanding AP and AR. based off what I'm seeing in terms of your bank balance, you need to collect from these people. And if you do, then we're good to pay these people. But if not, here's another plan. You could run multiple scenarios. The main point being is that we would produce the cash flow forecast and our recommendations around it as part of the weekly reporting process. So it fit in very nicely with just a very traditional bookkeeping process where, whether it's weekly, every 2 weeks, every month, every quarter, the main point being is you can just plug it in there with part of that process. Fits in very nicely, very seamless, and it just gives you the optics on the bank balance. As you would say, it's like creating the bank statement for the next 3 months or month or whatever that looks like. It's just producing that one piece so that you can give the assurance and peace of mind to the client that if we pay these bills, you're still okay and you can pay yourself and your rent and your payroll, and we'll be good on everything. And then that's actually when we would start running into transacting. So actually running it through Pluto or Veeam or any of the payment platforms, running the payments as well as trying to collect AR. So whether you use manual processes or Chaser or Invoice Sherpa, we actually would do that as part of our cash management process. We'll actually go out and help people pay their bills and collect their money. And then it all loops back up and starts again.
Yeah, perfect. Thanks for walking us through, because I think that, even when we create this ourselves, I think, wow, that looks complex. But when you actually walk through it, it's not. Yeah. And so if like I said, we'll send this out after when we send out the recording. And if anyone has any questions around what exactly do we mean here? What exactly are we doing here? Let us know. And also, as you were speaking, I was thinking, again, we've become so obsessed with helping other people. And especially when it comes to, how do you provide this as a service for your clients, which then contributes to your client's success. And this isn't the only way to get to the spot where you do cash flow forecasting. And so, if you look at this and you're like, that's not even close to my workflow, but I want to offer cash flow forecasting because I got a client who's basically begging for it, then by all means, let us know. And we'd be happy to jump on a chat and say, tell us about your workflow and let us help you kind of determine from our experience, is there any gaps or does your workflow also still lead into very successful cash flow forecasting? Or can we see anything that's like, oh, you might want to tweak this and here's why? We're happy to do that for anybody, because this isn't the only way. This is simply us sharing what we've had success with. And in some cases, we speak to people who don't even use like a HubDoc or CPank or auto entry, and they're asking, can I use cash flow forecasting? Or we had the question just, a week or so ago where somebody said, well, I do everything cash coding, so I guess I can't use Helm. And it's like, well, that's not actually true. It's just how you use it is going to be a little bit different than the person who does have a lot of AP in their system. Correct. So, again, I like to just kind of say that we're open books. And so anything that we can share with you to contribute to your experience or your service offering, by all means, let us know.
Absolutely. I mean, it's a great point. Cash coding is a huge one. We hear it all the time, more on the app side where it's, I don't have AP, I don't have AR. What does that look like? It actually looks the same. It's just that you've eliminated essentially this large chunk of my piece of paper. And that's it. The rest of it still occurs. The transactions still happen. You can still get future estimates. You can still put color onto the overall forecasting picture. And so you're totally right. It's a question of figuring out your particular workflow and what that looks like. Yeah.
And there's even some tips and tricks that we can share in terms of, if you are cash coding, how do you ensure that your cash coding is clean to get an accurate cash flow forecast efficiently? And so even things like that, we'd be happy to provide any feedback and any of our own experience that's going to help. So. Okay, perfect. Let's flip to the next slide. Let's jump into selling cash flow. And this one's always kind of funny. And even we had a little bit of difficulty deciphering between pricing it and selling it. And personally, I hate the word selling because I'm like, I'm not a salesperson and I don't ever want to be called a salesperson.
It's dirty.
But it just makes me think of, I just have this mental picture that I won't share. But, there is, at the end of the day, you are selling it to your client and you're convincing them or marketing to them or dialoguing with them in a way that makes them say, yes, I want to start doing that with you. And so biggest thing that we kind of both agree on here is that there's a huge emotional component to cash flow. running a business is so stressful. And for those of you who are listening who have your own small business, you know that it's stressful, and you know what it feels like to think, gosh, can I afford to pay this or that? And that's a huge stressor for a lot of small businesses. It's also the number one reason why small businesses don't succeed is due to cash flow issues. And so there's a huge emotional component to what it feels like to not feel in control of your cash flow or not even have any sort of optics around it.
Yep.
And then there's a different emotional component to having a sense of relief and what that feels like to know that somebody else has got your back and is helping you with that, piece of your business.
I think that's key to point out, is that it's not, you don't have to have the exact solution all the time. I think that's something key to point out. In our experience, we've always found that simply providing the optics and the approach of let's build a plan together, that in of itself will alleviate or answer the emotional component to it, because you're literally dealing with people that might be tight, or they just have uncertainty, and that then affects their kids, it affects their mortgages, it affects education and retirement plans. It affects all of these personal things that are all tied to their bank account. And so it's super emotionally charged. And main point there being is that you don't actually need the solution, the exact solution, and this is the exact roadmap you follow. It's very much an open dialogue and dynamic dialogue that happens every week, every month, every 2 weeks, whatever that looks like, where you're helping your client figure it out. And that's super dynamic. I found in my experience, at least, that it's more of an optics thing than it is actually a solution thing. Ultimately, you need to help them, obviously, but or else there's no value there. But it's very much an open dialogue.
Yeah, for sure. It's definitely, having them feel that they have somebody else who's working with them in that realm, and knowing that all that pressure to make sure that there's enough money in the bank in order to pay their bills, pay their staff, pay their rent, pay themselves, whatever that looks like, that there's enough money there to do that is kind of a shared responsibility. And in our case, for our clients, we have clients who they stop looking at their bank account entirely because we're doing this service for them. And it's a great practice for that particular client, because through the month they have very cyclical balance, like their balance goes up and down, and it's very, very cyclical. So certain times of the month they can log in and see their bank account and probably go into panic mode. But because they don't even go into that now, they don't even have to worry about having that stress. And that was kind of an eye-opener to me when she said, I don't even log into the bank anymore because it's too stressful if I go in at the wrong time, and I just prefer to know that you've got it handled. So
for sure.
So another question that we often get asked is, who's the ideal client to sell this service to? And I use that term in quotations because of the fact that I'm not a fan of that word, but kind of where do you start with delivering this service for clients? And there's lots of arguments around, should you start with a client that's a new client, or should you start with a client that's an existing client? I'm going to put you on the spot and tell me, what would you choose?
This wasn't supposed to be
I know, this is unscripted now. Here we go.
For me, it depends. I mean, that's the political answer, right? But if you've got a new client that obviously is coming to you for cash flow reasons, they've got troubles with, say, inventory, they can't, they need to buy it up front, and 6 months later they get their cash in the door, but in that 6 month gap, that whole dialogue right there would tell me with a new client, it's, you're getting cash flow services right away. I firmly believe that every single business out there needs cash flow management or cash flow forecasting at the very least. Whether you're in decline or growing or are very stable, there's use cases for every single company. So I do believe, as tacky and political as it sounds, it does depend, because you can apply cash flow forecasting, cash management to every single company. So it's probably more a case of, looking at your client base and seeing what the low hanging fruit is. And if somebody comes in the door at the same time that is also low hanging fruit, don't pass up the opportunity. And so that would be my answer to that specific question.
No, it's fair. I put you on the spot. So, and I think, something to add to that is, who's the ideal client to start with also depends, kind of, even this goes back to workflow as well, is what type of service have you been delivering in the past? So if in the past you've been delivering annual engagements to your client, and now you're saying, I want to start to deliver this service, and you go to an existing client who's very happily in an annual engagement agreement,
Mhm.
it might take a bit of time to warm them up to
Yep.
an entirely different workflow and cash flow services
Yes.
versus, and we spoke to somebody just last week at the event that Jenny and I
Yeah.
did, where she was saying that she's typically on annual engagements and she wants to get into advisory, and how she's struggling. She talks to the client and the client's like, yeah, I totally want to do that. And then when she talks to them about what that's going to look like in terms of the price and in terms of even the commitment to the client, because it looks very different now, or the commitment from the client, sorry, then they lose interest. And because that's a tougher sell than somebody who's coming in new to you, where you can right out of the gate say,
Yep.
this is the workflow that we're going to follow. And they'd have no other comparison, at least from your firm, maybe from another firm or another bookkeeper, but not from working with you. They have nothing else to gauge that off of or compare it against. So in that case, it could be an opportunity to say, start with a new client and then build up your efficiencies, your tools in your tool belt, gosh, your confidence in terms of delivering some of these really difficult conversations that can come with doing cash flow, and then take that back to the clients that are in your book of business when you're in more of an annual engagement type scenario. So you're absolutely right that it depends, and I think there's a number of reasons why it depends, and so I think it's a case of kind of looking at what are you currently delivering, who's in your book of business, what types of businesses are they, and is anybody, this is a great lead into the next slide, is anybody screaming for it? And what I mean is know that your client's not going to come to you with these precise words of, I would like you to start doing cash flow forecasting for me on a weekly basis. That's not what it sounds like. I've never heard anybody say
nice.
that.
Be nice.
It'd be so obvious, because then it's like, perfect, here's what I'm going to charge you. And here's the stress it's going to take off of you. It looks like a variety of different things. It can look like you looking at their bank account going,
Yes.
oh my gosh, they are tight to the pin always.
Yep.
It can look like they missed their first mortgage payment,
Yep.
rent payment,
line of credit,
something that was not comfortable.
Yep.
That's what it can look like. It can also look like them coming into your office or jumping onto a Zoom call saying, oh my gosh, I'm so sorry I was late. I slept in this morning because I didn't get to sleep last night because I was so stressed out. Like,
looking at my budget.
There are so many things that it can look like, sound like. And so know that you've got opportunities with probably a lot of the clients in your book of business. And we'll kind of speak to how, as Kelvin says, all of your clients in your book of business, but know that the ones who are probably screaming for it aren't saying, hey, could you do a cash flow forecast for me?
Yeah, for sure.
So as Kelvin talked about already, in terms of the low hanging fruit, the clients who are short on cash, the ones that you see yourself, that they run super tight to the pin, that they're always struggling to ensure they got enough money in the right accounts on the right dates for automatic withdrawals or whatever. Those ones are an easier place to start because they're already feeling some pressure where they're telling it to you when they're looking in their bank account and it's tight to the pin. I can assure you that that's stressful and that doesn't feel comfortable for them. So that's one obvious place. The other one is, and this came up in a conversation I had with somebody last week too, is she went to her client and said, hey, have you ever thought about me doing cash flow forecasting for you? It's something that I'm going to start offering for my clients. And the response from the client was, I would love it if you do that because I'm trying to do it myself. And I didn't even think to ask you to do it because I didn't think, again, if it was more of a traditional type role that they had in the past, I didn't think you did that. I didn't offer that service. So that's a really good place to start because I can assure you that business owner probably has better things that they could be using their time for. And in a lot of cases, they're not doing it right. So,
what?
But it's a great client to offload that from the client and who's going to be willing to pay for the service and the value because they know the time it takes them to do it and the stress that goes into to even doing it.
Yeah, I think those first two are great examples of people that will see huge value in it. The problem with the first one that you always have to be cognizant of is the scope creep. Those are probably the most dangerous clients, or the ones that are the tightest on cash because they tend to overreact. They're super emotional and justifiably so. I'm not saying that it's not right to feel that way. It's just it creates complications in how the workload looks.
Mhm.
So as a practitioner, you actually have to be cognizant of that, is that sometimes everybody always defaults to the people that are tightest on cash are the best ones to offer this to. And it's a double-edged sword, because these are
Mhm.
also the people that might not pay you because they're so tight of cash, and they're super emotionally charged. So there's
Yeah.
other complications with it.
Yeah, for sure.
And the managing cash flow, I mean, is a prime example of where there's a value add, because you're providing peace of mind, and you're letting them run their actual business. That's huge.
Mhm.
I like, one that speaks to me is a company that has customers that consistently pay late. And that it's because that's most companies. That's why I like it a lot. I don't
Yeah.
know a single company out there that collects on time
Or early.
all the time for every single company, or early. Exactly right. And for a bookkeeper or an accountant, that's a huge area of opportunity, because what you can do is you can say, well, this is what you're doing now, and this is how much money you have, and you can be hyper profitable. But if you got everybody paying in, say, 10 days or retainers or 30 days, whatever the more appropriate and consistent time frame would be, you can literally show that company and that individual how much more money they will have in their bank account. So, in terms of talking anchors and selling points and stuff like that, like that's a huge anchor, because you can literally tell a client, look, if you just follow these steps and do this, and I'm not saying it's easy, it's going to be a work in process, but if you do it, I can put X $1,000 in your bank account. That's a super easy sell for somebody, because they instantaneously see the value. It's an ongoing service. So that's just one aspect of what you would be helping them out with. You could also make their AP more efficient. I mean, you can start selling off of that. It's just one simple aspect of what we're talking about.
Yeah, and just before, were you about to go into the next one?
Yeah,
Sorry, I want to jump in one other thing, is that a lot of times from our experience with cash flow forecasting is it's not actually a cash shortage, it's a cash gap.
Yes.
And that our clients are feeling like they're tied to the pin, but they also have this habit of paying vendors the minute that the bill walks in the door,
Yeah.
and not wanting to call on their AR that's past due. I don't want to bug them.
Yeah.
And so that creates a cash gap. And so that can be what I'll call an easy win in terms of managing the AR and managing the timing of the payables.
Yep.
And quickly you can go from there being this gap to it actually being the other way around, where now if you collect on time, or even sometimes it's even changing the process. I mean, we have I think I've alluded to this example before, but it fits really well here, where we have an IT consulting company where he charges a lot of his clients on flat monthly fees. But yet he bills really slow because he's trying to do his own billing. This is before we started to work with him. He's billing really slow, like literally a month late, and then giving 30-day terms, and then never following up on those terms. So people were consistently 90 days on a flat fee billing. And for those of us who've heard the concept of flat fee billing and collecting that either up front or at the very end by automatic withdrawal or pulling off of a credit card, the same applies with him. It's the exact same concept. Right. And so there was a great example of him being, I don't have enough money. It's like, well, here's an idea. And there was kind of a few steps there. Firstly, billing on time. And then secondly, could you start to do automatic withdrawals for these people? Because there's no surprises. They know exactly how much are being billed. So,
and it's a convenience.
He just never thought, exactly. He just never even thought about it and didn't even think that would feel comfortable to deliver that message to his customers. Yep. But once you show him, here's what difference it can make, and then you won't be as strapped for cash, then he was like, okay, I get it. Yep. So yeah, it's something to look at, is that timing and that gap.
For sure. And it segues into the last point that we have here is capital and cash efficiencies. Again, going back to the low-hanging fruit isn't necessarily always the people that are the shortest of cash. Maybe sometimes it's the exact opposite. And I have a favorite client that I like to pick on because they always had a ton of loans and a ton of cash and everything in their corporate accounts, but they never paid themselves personally. They wanted to essentially make their financial position look so good corporately because that's what they always looked at, and they just never looked at their personal selves that much. And we found it really interesting because they had these large cash balances, a really, it was a vet clinic, so a very, very, very good cash flowing company to the tune of $400,000 to $500,000 per year. Did extremely well, but their problem was the exact opposite. They were actually strapping themselves personally so that their company looked better on the financial statements, because that's what they always dialogue with the professionals about. And so prime case of coming in there and saying, look, you should have, our metric is 3 months of G&A, of salary. So if all revenue falls apart and, the world crumbles, you'll still at least be able to pay people for 3 months and figure stuff out. So that's kind of our rough metric. And so if you use that, you should be distributing everything over and above that outside of some capital spending. So if you have to buy an X-ray machine or a piece of equipment or do a renovation, whatever that might look like, you still want to plan for all that. But everything else should be going to you as a person, because the whole point of opening a business is to actually do better for yourself, to be in control, have the flexibility, but actually still make money to some level. I'm not talking like wads of cash, but at least a comfortable living.
Yeah.
So in this particular case, these people were actually doing the exact opposite. They were actually, not living in squalor per se, but they were literally strapping themselves more than they should have been because their company was doing so well, but they weren't seeing any of those benefits because they just parked all the cash. So our cash management position there was, let's be really capital efficient. Let's be a little more strategic with it. And the value to you as the end consumer is you actually get paid, and you have the comfort knowing that even though you're getting paid more, which might actually feel uncomfortable because you're not used to it, it's actually, we're looking forward. You see the optics, you can see the plan, like you'll be okay.
Yeah. And I think just seeing those optics that, you follow the, like, whether it's a graph or whatever it is that you're using as a tool, and showing them, look, like you'd have to have 3 months of literally nobody walking through the door, not one person. And in the industry of a vet clinic, that would be very bizarre. And so, you can take that into consideration too, to say, like, look, like, you're going to see a decline in appointments before you get to the point that nobody walks in the door. And so you've got time to react, and 3 months is certainly adequate from our experience. And so here's what you're holding in the corporation, excess of 3 months that you could be paying yourself and paying off your personal mortgage, etc.
Yeah, exactly.
All right. So let's just share a little bit about our selling experience within 2080 when it comes to cash flow.
Sure.
All right.
I can go. Again, for us, the biggest selling piece, in my opinion, is again, it's going back to the emotional piece. I really truly believe that we as accountants and bookkeepers really undersell that aspect of it. We're really good at quantifying things and saying, I've spent 25 minutes on this, it should equal that times whatever my billable rate is, which has some profitability metric in it. And that's fine and dandy. That totally makes sense and does work for some people. But again, coming back to this side of the equation, you're probably leaving some stuff on the table, some cash on the table, because again, you're dealing with the most important piece of any business's business, which is their bank balance. Every company survives off their cash. Every company looks at their cash. That's how most small businesses actually measure their financial success, is their bank account going up or down. And so the emotional aspect is really, really large. And so the way that we've always sold our services is by providing peace of mind. So it's saying that we will handle this whole process for you. We'll take the stress, the emotional component off of you. You can focus on your widget, focus on your service. You can do everything that you're awesome at. We'll do what we're awesome at. And together we'll create this awesome team and company, and we'll run things together. So we've really sold people on the emotional component of it, taking the stress load off. The convenience has been a huge one, which again comes down really to a stressor or an emotional component. Most small businesses, again, are super tight for time. And so any efficiencies that you can give them, or convenience more so, there's upselling available there. So our entire marketing platform, so to speak, was really hinged off of the convenience, the sheer convenience, and the stress reduction and the emotional component.
Yeah, absolutely. And I think the only other thing to add to that is the other point on the slide here is we've always tried to be really clear with the client in terms of what the expectation is, what are we going to deliver, and what's their participation in the process. Because if their participation in the process, as we showed in that workflow, was getting their backup into, auto entry or HubDoc or Receipt Bank, and then dialoguing with us after the cash flow was completed, those are the two pieces that they have to do. And truthfully, if they stop doing one of those two things, the whole thing kind of breaks down. And so it's important that they understand, we're going to take all of this stress off of you, and we're going to be a partner with you and provide value to you that you maybe have never experienced in the past. but you have to know that these are your two jobs.
Mhm.
and the only way that we can deliver what is most important to you, which is having somebody forecast your cash, so you've got the optics, and helping you manage your cash, is that you have to get your backup into the system, and you have to be available to be responsive to the questions that I have. Because when it comes to forecasting your cash, beyond your AR and your AP, let's be honest, it's your best guess as to what you think is going to happen. And without dialogue with the client, especially around revenue, but even things that are new coming into the business as an expense, you're limited in what you can provide to the client. You're using your best guess. Meanwhile, they've got some intel that if they just shared that with you, like, I know that I ran a new advertising campaign and I'm going to expect more in revenue this month or less in revenue this month. I've just hired somebody, they're going to start in 2 weeks, whatever that is, that's going to contribute to you having a cash flow forecast that's more accurate and more realistic, and that you need that in order to be able to help manage the cash.
Yep, totally agree.
Perfect. All right, I think we're at the point, where we'll take a few questions. I see that there's a few that have popped up here, and if you've got anything else, please shoot it in here. So I'm going to read this first one. I'll read it and you can answer it, Kelvin. I'm having such a hard time converting clients from compliance clients expecting only a tax return or a once a year financial statement to want, let alone pay for advisor services. What is your tip to get that conversation started and have the clients realize they want and need these services?
Yeah, and I think that goes back to what we talked about before, which, who should you pick? Should you pick new clients or existing clients? And the answer is, it depends. In terms of people that are on an annual engagement, sounds to me like they might be price sensitive. To me, that would be a question of, what does your marketing funnel maybe look like that is bringing in new clients? Because the effort that you're putting out in potentially getting new clients relative to the effort you might have to put in to convert a tax compliance only person who maybe does have some price sensitivity there, maybe that is more costly than simply reaching out and finding a new client that simply you advertise directly to them saying, this is my new specialty, this is what I'm offering, I'm going to crush it all day long, do you want a piece of it? You'll probably get way more engagement and value out of that relative to perhaps marketing to somebody that might not actually want the service.
Mm-hmm. And it's, from our experience, we've struggled with marketing the service, because when you put out traditional marketing,
Yes.
you find that people are very price sensitive, or they're looking for that annual engagement
or
of
the
filing your tax
cheapest
return.
version.
That's what I mean by price sensitive. I was trying to
be nice.
Trying to be nice. They just aren't willing to pay for the service. So it is tricky to market and get those people. I mean, our biggest marketing tool has always been referrals through our existing clients, through people like our lawyer and people at our bank and that sort of thing, who have already kind of laid the groundwork in terms of what to expect when they're coming to us to talk about our services.
Yes.
So, okay, we got a couple more questions. We're running low on time, so let's try to get through as many as we can. Can you expand on what you mean by cash management? Do you mean using bill pay tools? So, yes, short answer is yes. That is what we mean in terms of cash management. We mean that we're in control of when money goes out the door, and that we are
potentially
using,
coming in
and helping with it coming back in as well. So, that's using that example of the IT consulting client, where it's like, let's set up a payment system where we can start to, we got the PAD agreement, so we start to actually pull the payments automatically from these clients or these customers. So yeah, it can be both sides. Definitely the easiest place to start tends to be in terms of managing the payments, and then work towards how can you also automate some of the collections as well.
Yeah. So essentially the way that we look at it is cash management would be everything coming out of the accounting system. So you have a lot of data entry systems coming in to Xero, QBO, Sage, whatever you're using. There's a lot of reporting tools that you can utilize on the way out, but there's no real process functionality that's automating what's coming out of an accounting system. And so those processes, meaning writing checks, following up with people, trying to collect, like all of those are very manual processes. So when we do say cash management, that is what we mean. We're actually controlling and providing the service of all of those different workflows, depending on the client. Maybe one client only wants bill pay because they're a retail chain and have point of sale system. So we can't control the inflows, but we can control vendor payments, supplier payments, inventory management payments, and potentially not even controlling all of it, but offering some guidance on what that looks like.
Yeah, for sure. And okay, I think we have time quickly, 1 minute for one more question. And this one is, do you have a rule of thumb on a cash flow forecasting management package? I've heard some people using 1% of revenue. We do not use that theory, but I have heard of other practitioners using that theory. It's never something that we followed. Again, we kind of go by the art and determining, what is the value to the client. And truth be told, there's some clients, just before we jumped on this call, this happened. There's some clients where you're just not a fit for them. And I always like to say, we're not a fit right now. And that can be, their budget, that can be where they're at in their life cycle. That can be, sometimes it can be, they haven't felt enough pain in terms of having an experience that maybe hasn't put them in a good spot financially.
The price sensitive people.
Exactly.
We'll figure that out.
Sometimes those people do feel the pain at some point, and then they circle back with us. And, that does happen. But we have not ever used any sort of metric like that to dictate our pricing. So.
Yeah. And to speak to that point too, one fallout or problem I would see with that measurement would be sometimes, because you're dealing in cash management or cash flow forecasting, it's a lot of it can be transaction based. And so we have had it in the past where our smallest client in terms of revenue, because they were making nothing, actually was our biggest client in terms of cash flow forecasting and cash management, simply because of the sheer volume of transactions. Yeah. So not saying that it's not a good measure, it'd actually be a really good way to kind of do value pricing on bigger companies, I think. But you've got to really watch the smaller companies. So people that are low revenue, but have a ton of transactions and a ton of different transactions, because now you're dealing with a lot of complexity, but no revenue to then base your value off of. Yeah. That's the only problem I see with that.
Absolutely. All right, we're 1 minute over time. Just want to wrap up with a couple of things here. Firstly, before I forget, if we love feedback. So if you guys have any feedback for us around what you're liking, what you aren't liking, and then also what you would like us to speak about next, we've got a couple of ideas still brewing, but we want to talk about what you guys want to hear. And so please shoot us a note if you've got anything in that regard. I've put our email addresses up onto here. We have a Facebook group called the Helm community. So feel free to join that. That's other practitioners jumping in and talking about things around advisory and cash flow. And of course, a link to our website. I think we've covered everything. So,
I think so.
All right. Thanks everybody for joining us today. We look forward to your feedback. Any questions you have, feel free to reach out to either Calvin or I. Yeah. And we look forward to seeing you soon.
And if you're in Canada, we'll see you maybe at
QuickBooks Connect. We're going to be at QVC. So if anyone's going to be there, stop by our booth and say hi.
For sure. Thanks.
All right. Bye.